For the past 2 years, people who have wanted to have unsecured loans one after another have had a gala time by borrowing money or small ticket loans via digital apps. But not anymore, because this has led to an inevitable over-leverage in the financial system. This over-leveraging has caused banks, NBFCs and fintech platforms to relook at their business strategy as well as credit underwriting models. Therefore, this means if you need a personal loan now, it may not be as easy as it was. Let's understand the problem better. What exactly is over-leverage? How does it affect you and me? And how is it measured? An over-leveraged borrower is when an individual has so much debt that it becomes almost impossible or extremely difficult to repay that amount. Now, to measure this, every lender, the one who gives the money, has something called Fixed Obligation Income Ratio or FOIR. This is a ratio which indicates the lender's risk-taking ability. For example, if a lender has a FOIR of 25% and a borrower has taken multiple loans from different entities, then in case the FOIR exceeds 25%, the loan application is likely to get rejected. For banks, the FOIR is low, and for fintech platforms, the FOIR goes as high as 50%, which is why borrowers rush towards digital lending apps for easy money, because high FOIR for fintech platforms indicates their willingness to issue back-to-back loans quicker than traditional banks. Besides this, lenders also look at several other variables such as income growth, repayment history, bank statements, device data, and behavioral patterns to underwrite a borrower. Underwriting a borrower is basically assessing the risk related to repayment of the borrowed money. To combat over-leveraging, let's first look at what banks are doing and then what fintech platforms are doing. Banks have fine-tuned their credit criteria in terms of how much money they should lend to a particular borrower. They are also recalibrating their co-lending arrangements with fintech platforms. On the other hand, fintech platforms are now migrating towards traditional underwriting models which banks already use. They are also changing their business model from a burn and churn model to a building the book model by offering longer tenure loans. Moreover, apart from personal loans, fintech platforms are now exploring other avenues for growth, such as lending to MSMEs and offering loans against property. While all of this is going to make it difficult for borrowers who are taking and have taken multiple small value loans, the first-time borrowers will take a massive hit.